When I first started getting very deep into technical analysis, I became very active in the CMT Association, and I was on an email list with some of the best technicians in the business. And everyone was really focused on when to buy, when to sell, a lot of statistical measures. I remember asking the question on an email chain, rather than trying to figure out when to buy or sell, is there any way we could predict what the next trend would be? And I remember someone kind of answering me as if that was kind of like a funny question to ask, but looking back, I still think that was a really important question. And in reality, I think Bill O'Nil answered that question. All of the bases that we look at, that we call shapers, I call them shapers because they are really shaping the trend. That was the answer to the question I was asking. How do we know what's coming next? Well, you need to look at the basing structure that's currently forming. Properly taking apart a base and all of the characteristics, that will show you if that stock is being accumulated during that congestion period or being distributed. For that reason, the name base is really just too generic and used too loosely. And I really want to refer to these types of patterns as shapers because they're very specific, they're very unique, and their characteristics are really displaying that a new trend is basically being shaped here. So in order to understand how a base comes together and the dynamics at play, let's take a look at how trends unfold and why a base develops. So here we have a chart of C Limited that goes back a couple of years prior to its huge up move after the COVID-19 pandemic. And you can see prior to the base that formed during the pandemic, we already had a strong uptrend, which was displaying that there was institutional accumulation. The market had already recognized that there was a strong growth story going on here within the market. Now, after a prolonged advance, it's only normal that demand and supply come into balance. So basically, we get to the point where buyers start to reconsider whether or not they should be paying a higher price for the stock, and sellers are a little more aggressive in selling their stock because they think they're getting even better prices. And so that's a normal part of the back and forth flow of a market trend. But when a base is forming, we actually have a more significant move lower where sellers really dominate over buyers. Now, we don't have to continue this chart to the upside as we see here in C. Oftentimes, a stock tops and just enters into a downtrend, and that's the end of that trend. But a shaper pattern is really shaping that next part of the trend. And that begins at the bottom of the base, as we see right here. So instead of just continuing into a downtrend, we re-enter a point of equilibrium where we have sideways trading. And you start to see areas things such as gaps higher and significant closes off the low of the day. That shows that buyers are still present in the stock. Other aspects, as well as a higher low here on the right side, show that prices are not just moving lower and making new lows. And the fact that we can re-accelerate higher and test prior highs shows that in that equilibrium that formed at the bottom of the base, it resolved itself with buyers being more aggressive than sellers once again. And it's very normal on the right side of the base to see another point of equilibrium, another turbulence zone when we reach the prior highs of the basing structure. Essentially, anyone who had bought prior to this downtrend is reconsidering whether or not they made a good choice. And some people decide to take off that position, and that creates a short-term point where there's supply that comes back into the market. That's why most of these bases you'll see will have what we call a handle, and that's really just the right side consolidation before a significant move higher. Now, obviously, the two best points to buy this stock is once the bottom equilibrium breaks higher and once the top equilibrium breaks higher. Those are really the 2 points you want to focus on, and that's going to be the aim of using all of our short-term tactical patterns, which we'll learn later, to time our entries within the basing structure. Now that we know how these trends come together, what's really important is that we define what the criteria is we're looking for. It really goes beyond just price pattern because these same dances that occur between buyers and sellers really occur on all time frames. You can see this on a 2-hour time frame, a 2-week time frame, or a 2-year time frame. So by having specific criteria that you're looking for to define what kind of a base that is going to drive these significant moves higher, it's important that you have criteria for that. And William O'Neill provided those in his classic book, How to Make Money in Stocks. So shapers are really the core of the Active Growth Investor program. It provides the perspective and the anchor you'll need to tie in together all your short-term patterns and all the different buy and sell points together. So I know there are many elements to these shaper patterns, so we're going to start with Booking.com as a case study to look at all the key characteristics and elements that distinguish a high-quality setup from just any other base that you'll find on a stock chart. Again, I strongly recommend that you review How to Make Money in Stocks and all of the weekly charts that book begins with, because it'll really help to train your eye to see all of these different patterns. We're going to go into multiple examples of each pattern, but the ability to have over 100 patterns over 100 years is really an important tool to help train your eye into seeing them on the stock chart. Before we jump into all the specifics of the shaper patterns and all their criteria, I just want to take a quick pause and cover some charting basics. It's really important when you do your own studies that you have your charts set up properly and you use the right scaling. It may not seem like an important issue, but it's really important that you set your scales properly so your eyes get accustomed to looking at the right types of charts. We're going to look at two exact same charts of NVIDIA. We're only going to change the y-axis, which is the prices here on the right side of the screen. This scale here is the improper scale. This is an arithmetic scale which shows equal spacing between each of the chart units. So for example, a $10 change from $10 to $20 will look the same as a $10 change from $50 to $60. However, if we change the scale, and now we're looking at the exact same NVIDIA chart over the exact same period of time, but with a logarithmic scale, it's set up to measure price distances, but in percentage terms. This means that a 100% advance from $10 to $20 will look exactly the same as a 100% advance from $50 to $100, even though the first advance is only $10 and the second advance is $50. This is really important because as the stock price continues to advance over time, if you don't adjust for this scaling issue, all of the stock price movements later on in the stock's advance will look substantially larger than all of the earlier moves at lower prices. So this normalizes percentage moves on a stock chart, which is really what's important to every investor. It's not the amount of dollars you make, but what percentage you can move your account by.